Hello, everyone. I'm Joe Gallimore, Director of Investment Management with Argent Bridge Advisors, and welcome to our October Cup of Joe. So, top of the headlines right now is the shutdown of the federal government. Naturally, the question we're hearing is, how is this going to affect my investments? So I thought today that we'd briefly walk through what some of those ripple effects might be and how they will affect you personally. So a government shutdown shouldn't materially affect the economy, at least not initially. Most government roles are not directly related to day-to-day business. And, many roles are considered critical, such as TSA employees that keep the airline industry moving. Those roles deemed critical, they're required to work throughout a shutdown. So there's no immediate worry of lots of economic fallout. The second point that's encouraging is that most government shutdowns do not last very long. I believe there's been 10 government shutdowns in the last 50 years or so, and the average length was 8.5 days. Now, I know the current shutdown has already lasted longer than that, but with every day after that, political pressure mounts on both sides, and that compels lawmakers to come to compromise because no one wants this. The third point is that is remembering the scale of what this is in the U.S. economy. You'll hear rumblings of, the government is affecting a couple $2 billion a day, this and that. Well, the U.S. economy, the size of the U.S. economy is $30 trillion per year. So $10 billion is 0.03% of the economy. So if the delay gets drawn out, it may start to shave off fractions of a percent of the GDP, of the quarterly GDP number, but it would take a significant amount of time for shutdown-related hindrance to really add up. And I'll caveat, this is true in the general sense. There are certainly companies out there, such as government contractors, government consulting, that will immediately feel a slowdown in business. One of the biggest anticipated effects of a government shutdown is a pause in the reporting of data that's tracked by government agencies. An example of this is the unemployment rate. It's published by the Bureau of Labor and Statistics. So a pause in this sort of data, you might see market participants at the institutional level, they may slow down their investment activity until the shutdown ends and that data starts coming at a regular cadence again. But as with everything, context is important. And by that, we mean, what could this shutdown mean in the environment we're in today? Valuations of the US stock market, they've been stretched pretty much all year. So this wrinkle may be a catalyst that investors use as an excuse to take profits and gain some clarity while they wait out a government shutdown. So you could see it spark a little bit of volatility. Another potential second-degree effect is that I've heard mentioned by some market strategists is that the Fed may err on the side of easing with interest rate policy as opposed to staying tight. This has historically been good for stocks. Now, in coincidental timing, our investment committee decided to rebalance our models and take advantage of gains in US equities so far this year. Now, this was done very recently, and I say coincidental because the government shutdown was not a consideration in making this decision. But with this rebalance, it will bring our bond allocations back to their target weights, which should play defense if there is some equity volatility as a result of the shutdown. The rebalance also allocated some money to international equities, which is diversification away from the expensiveness of the US market, and will benefit if the government shutdown ends up actually dragging down the US dollar. Now, to switch gears for a minute, I want to close out this month by addressing a topic that we've received a few questions about. Recently, 60 Minutes did an excellent interview with financial reporter Andy Sorkin. Now, I love 60 Minutes. I thought this was a very good piece about modern investing in general. In their interview with Mr. Sorkin, it laid out a lot of interesting observations about the market today, but then it ended with a blanket question, of course. Is the market going to crash? Now, When this was asked, the interviewer asked this question in hyperbole, and Mr. Sorkin's answer matched that hyperbole in its simplicity. He said yes. But I also believe he was answering from a perspective of market history. He was not making a market call, and he was simply alluding to the fact that market declines are inevitable. And that's why he followed up his question with two very important qualifiers. He said, I can't tell you when, and I don't know how deep. If that's not ambiguous, I don't know what is. But to illustrate what I believe he was referring to, I prepared this illustration for everyone. And these are historical drawdowns of the S&P 500 index, using the S&P 500 as a proxy for the US stock market. And what you can see since 1950, about the past 75 years, that market downturns are frequent. They happen all the time in different magnitudes. In actual bear markets, which is a decline of 20% or more, that's happened 10 times in the last 75 years. You could almost make the case for 12 times if you count these ones that got very close to touching 20%. So yes, there are parallels of now to past times which preceded market declines, namely that stock valuations are stretched, the US economy is not at full strength, and the AI theme is getting lots of bubble speculation around it. But I've heard many strategists during the past few quarters really comment that the main difference between today's markets and previous bubble markets is that today's companies are backed up by cash flow. Their earnings growth for many companies, especially the largest ones leading this rise, has been very strong. And it's expected to continue at a substantial pace. So what this is not a market frenzy that's bidding up the price of unprofitable internet stocks like we saw in the late 90s. And it's not housing prices going crazy, fueled by lending to citizens who really can't afford it. That's what we saw during the 2000s and resulted in the great financial crisis. So there are parallels of then and now, but the fundamentals are materially different. But if and when we see a market correction of whatever magnitude, your strategic allocation is designed to weather those periods. And again, like I said, we've rebalanced our portfolios. We trimmed US equities, we bolstered bond allocations back to their targets, and we bumped up our exposure to international stocks for diversification into markets that aren't exhibiting bubble characteristics. So that's it for this month's Cup of Joe. Call it Current Events Edition. If you want more insight, please like this video and check out our website or our YouTube channel. And as always, if you have any questions that we can help answer, please let us know. Thank you.